In 1980, interest rates were up to 18 and 19%. People were freaking out. And the adjustable price of a home in then dollars was about $200,000. Now, the national median house is about double that, but rates are not 18 and 19%, and yet most people are still on pause with their life. And it begs this question. If the Fed's rates are still paused and they're not lowering them, should I be investing or should I be waiting? Let's dig into that right now. Inflation is everyone's favorite buzzword, and here I've got $100,000, and here I've got $4,100. And with inflation at 4.1%, it means that if you have $100,000 that is equity in your home, stashed under the mattress, if it's a 401k or an IRA or the stock market where you keep your value, for every $100,000, you can take $4,100 and literally just kiss it goodbye, because inflation is destroying that part of your monetary value each and every year.
Oh, hell no!
Inflation is still running well above plan, and that means that the Federal Reserve is keeping its finger firmly on the pause button.
Now, whatever you do, don't push this button.
I'm good.
Which means, oh no, we were the Fed. We were going to lower rates and lower rates and lower rates. In fact, we thought we were going to do it 6 times throughout the year. And at this point, it's like, pause. I don't know if we can lower the rates just yet. Why? Inflation hasn't come down. Following their most recent meeting, this remains the same. The Fed is not doing any cuts right now. It also signaled that it's likely to cut rates only once this year, down from its previous estimate of 3 cuts. And earlier I heard about 6. And for some reason, they're like, uh-oh, this creates the fear of a big scare. Does this mean a crash is coming, or that you shouldn't buy a house right now? Or heck, it's an election year, so I just don't know what's gonna happen. I'm just gonna put my life financially on hold. Guys, pay attention to history. Do not let it stop you from making the money that you can right now. The Fed's aggressive rate hikes in 2022 and 2023 were meant to cool down the economy and ultimately curb inflation. But we're still below target. And why does that really matter? This has slowed the housing market significantly, making it tough for home buyers who now face higher monthly payments and less purchasing power. Mortgage rates hit 8% last fall, and they've come down a little bit to like 7.1% in June of this year. Historically, this is actually still low. Like if you actually look at rates over the 40 years, we're still currently below average. But since the Great Recession of 2008, we basically had a decade plus of free money. Everyone's habituated themselves to this idea of money should be free, like 3, 4, 5% max, and anything higher than that is crazy. And I'm like, I don't know, I'm an investor and I literally buy a home every single day, and these rates haven't stopped me, and I'm still making crazy good money.
That's crazy!
So remember, the best house that you can buy is the house that you can buy right now, because last year interest rates were higher and it was a great idea then. It's an even better idea right now. So what does the Fed even have to do with the housing market? The Fed's policies do set the overall tone for mortgage rates. Lenders and investors closely watch the central bank and the mortgage market's attempt to interpret the Fed's actions to affect how much you pay for your home loan. Ultimately, these changes impact affordability, which is bad for both investors and first-time homebuyers, but just on the face. This shouldn't stop a strategic investor from cornering ideal markets, but you have to know what you're doing. The reality is that a lot of people think that inflation is bad, and until it comes down, rates won't come down. But the truth is, inflation can also be really good.
Great, superb, excellent, good.
And I know what you're thinking, Kris, that doesn't make any sense at all, but I want to show you 2 things here. You see, you've got soft assets. This is cash, 401ks, IRAs, digital currency. This money, when you have inflation that's really high, it hurts the value of money. But if you've taken your money and you've transferred it instead into a hard asset, you actually experience the opposite. Like you might have wondered, like, why in 2020 and 2021 did houses appreciate so much? Why? Well, that's because inflation was really high. In fact, the worse inflation gets, the better you're going to experience depreciation in real estate, which if I look at the hundreds of homes that I've bought recently, when inflation was really high, I got really happy.
Well, that sounds even better.
The headline is, interest rates are bad because they're high. And they're high because inflation is high. And that stopped your parents from investing. Like, that's keeping everyone else paused. But why are there guys and investors like me that are really pumped about the market, and we're putting as much money in the economy as we can right now? We're not holding onto our cash. We're buying real estate like crazy.
Hell to the yeah.
Well, you actually have to understand that inflation is both good and bad. You see, it's bad if your money is sitting in the market, like a 401k or IRA, or literally physical cash under a mattress. That's not good. These are called soft assets, and they're negatively impacted by inflation. So in other words, the higher inflation is, the more your money is hurt. However, inflation is also really good if instead you own hard, tangible assets. A house is a tangible asset, jewelry or art. These things that are physical, when inflation is high, all of these things go up in value. So for example, think about the person that says, I've worked hard on retirement my entire life and I have $500,000 in retirement. And it's like, oh no, inflation just eroded like $50,000 of my money last year. It's like I have $50,000 of less buying power. That's bad. Well, you got the guys like me, they're like, I own so many homes, and guess what? The higher inflation is, the more they all go up in value. And literally overnight, I just made millions of dollars because my homes just went up a ton in value. Well, here's the crazy part. People are so concerned with interest rates. They're so concerned with inflation. But did you know that the 100-year average on inflation is 3.1%? And right now it's sitting at 4.1%. It's literally only up 1% higher than it normally is. And that's keeping people frozen from actually making financial moves and moving forward. Meanwhile, those of you like me that own hard assets and we're putting our soft assets into hard assets, we're benefiting from it. We literally have a system built to resist inflation. It's called owning hard assets, or in this case, buying real estate. There's no doubt that record low mortgage rates helped fuel the housing boom of 2020 and 2021. In the long term, however, home prices and home sales tend to resist rising mortgage rates. That's because life events that prompt a home purchase, like the birth of a child or marriage, rarely correspond with mortgage rate cycle. So the current slowdown may be more of an overheated market's return to normalcy rather than the signal of an incipient housing crash. Remember, the 100-year average on inflation is 3.1%. We're only 1% over that. So now that your irrational fears are hopefully out of the way,
Oh, thank God.
what are your actual next steps for those looking to buy? Despite elevated mortgage rates, investing in a home can still be a possibility for you. Knowing the hot markets to buy in, or how to leverage equity in your home, or the buying power from your 401k by consulting with an expert is critical in securing the highest ROI decisions that you can make. And it just so happens that you know a guy who loves to give you expanded perspective on your options and possibilities. Because if you're caught up in the old system of, I put money in a 401k for my company match, or I put money in my IRA to lower my taxable income by 0.0 who cares percent, or if I've been trying to pay off my house, those choices, I can financially forecast where you will be at retirement. I'm gonna tell you right now, it's not gonna look hot and it's definitely not gonna be sexy. However, there are other investment choices you can make that are conservative and in many ways safer. And what they really do is give you a possibility for the kind of retirement that you want. But you're gonna have to rethink your 401ks maybe, or your IRAs, or the equity in your home, because there's some different choices that you can make, frankly, that make you a lot more money. If you'd like to get my perspective on what I would do in your financial situation, or if you're concerned with how do the rates fit into your personal game plan, or whether you should buy a house or sell a house or buy more houses, let me give you a multimillionaire's perspective on what you should do exactly to the T. In fact, if you click the link below, fill out your contact information and let me and my team be in touch with you, let me show you exactly what I would do. Doesn't mean that it's the right game plan for you, but what it can do is give you perspective. And literally 99 out of 100 free game plans I supply to people, they find such immense value in having perspectives of a very successful person. So if you want to know what I would do, click the link below, fill out the information. Let me show you your fastest path to becoming a multimillionaire. Well, real estate just might be difficult altogether for you. Maybe you can't use your credit, or you've got some other technical hang up on why you can't buy real estate. But you know, I really don't take advice from my credit score, and I definitely don't take it from my pocketbook. Instead, there are several different ways to buy real estate with no money. In fact, there are 5 techniques I love to use for acquiring real estate with no money and no credit whatsoever. And if you want to know what they are, click right here and let me show you this video on creative financing.